The topic is lessor's accounting, guys. Same accounting treatment that was actually in IS 17. So IFRS 16 has adopted the same accounting for the lessor. So the no change for the lessor in terms of lease accounting. So first, lessor has to decide whether it's a finance lease or operating lease. If the lessor has decided that it's operating lease, it means it's simple a rental arrangement. Substantial risk and rewards of the asset has not transferred to the lessee. It means the underlying asset belongs to lessor. It means it will not be de-recognized from the lessor's books. So it will be treated as per IS 40 or IS 16. If the car is being leased out, obviously it's IS 16 asset. It will be treated as per IS 16 under cost model or revaluation model. If a building is given under an operating lease, then we have to see whether it's a part of IS 40 or not. If it's a part of IS 40, then obviously it will be categorized as investment property and we will apply the accounting of IS 40. So the lessor will continue to recognize its underlying asset. He is not going to de-recognize the asset. Now, what is the rental income, the installments received treatment? It will be charged to P&L. It will be charged to P&L as income over a lease term on a straight line basis. On a straight line basis. So this is important on a straight line basis. So any income received will be treated as. Now you can apply the formula. Formula is all amount received from lessee, all amount received, net of allowances or net of incentives given. It means you are going to deduct any incentive given and you are going to divide it with lease term. You will get, if you are going to divide it by number of years, obviously you will get per year income. If you are going to divide by months, you will get per month income. So after that, you will see how much income is going to be recognized in a particular year. So this is a treatment of operating lease. Remember, no asset will be de-recognized from the lessor's books. It will be in lessor's books and any rental income will be treated as income on a straight line basis. Now, if it's a finance lease, it means the substantial risk and rewards has been transferred. It means we have actually sold an asset as a lessor. So it's a sale arrangement, you can say. In finance lease, you need to check whether lessor is a financial institution like bank or lessor is a manufacturer or dealer. What is the difference? Just see what is the accounting if lessor is a financial institution. So bank as a financial institution is not selling the asset. They are actually giving loan on the name of lease. So debit will be lease receivable and credit will be cash. So they are giving cash away. They are not giving assets. So the asset entry will not be there. So lease receivable to cash. These entries will be with net investments. What is the net investment, guys? It's the present value of gross investments, and gross investments includes minimum lease payments, what actually minimum the lessor is going to receive, and plus ungranted residual value. Ungranted residual value which lessor is going to receive, but it is not granted by the lessee. Why we didn't included the granted residual value because it is already included here. So granted residual value is already here. Now the value will be given to you. You will take the present value, that will be your net investment, and you are going to book the lease receivable and cash. Subsequently, if you are receiving installment, and obviously you are receiving installment, you are going to split them into principal and interest income. This is income, remember. The principal amount will reduce lease receivables. So this is the same treatment that we have already done in lessees as well, where the installments paid is going to be divided between principal and interest expense. Obviously, it's lessor's accounting, so it will be divided between principal and interest income, and the principal will reduce the lease receivable. Now, what will happen if manufacturer or dealer is a lessor? It means they are actually selling goods. They are selling goods. It means when they will sell goods on installments, we will say that it's a lessor, and the lessor is a financial. It's not a financial institution. Actually, it's a dealer or manufacturer. So what they are doing, they will pass a journal entry lease receivable to sales because they are selling the goods. Okay. So debit is lease receivable, credit is sale, and the amount that we are going to use for journal entry will be lower of. This is important. Lower of fair value of the goods. Fair value of goods. And present value of lease payments at market rate. This market rate is really important so that we can avoid the inflated revenues, the recognition of inflated revenues. So that inflation, according to the rate adjustments, they cannot book the higher sales. So market rate, you will take the present value of all the lease payments at market rate. Whatever is lower, you will book the journal entry lease receivable to sales. On the other hand, you are going to de-recognize the goods as well, and we know what is the de-recognition entry whenever you are going to sell the goods. So after sale, you will always pass a journal entry, which is you are going to credit inventory and debit is cost of sales. Now after passing this entries, guys, after that we will receive the installments, and installments will be divided between principal and interest received. Now this is the same treatment that we have already learned. So the most important is, it means when dealer or manufacturer is a lessor, they are earning two elements. The first element is principal and the other element is interest received. Thank you so much, guys.